Welcome. Today we're going to talk about the common misconceptions on the best way to fund college retirement for your children. Now, the most common belief is that we use a 529 plan. But today I'm going to show you some of the reasons why you want to learn a lot more and why you want to figure out that is that really the best way or is there a better way to do it? See, you can't properly plan for something you don't fully understand. College expenses are increasing by 5 to 8% annually. The average increase for state schools is about 8%. The average increase for private schools is about 5%. The total cost of attendance for a state school average is $21,000 a year or $42,000 a year for a private school. This includes tuition, room and board, books, transportation, and miscellaneous costs. This isn't going on and getting a doctorate. This is just getting your basic college education. And it could be way more expensive should you go to something like USC and go to medical school. One senior, 5 years in state school, will cost $125,482. A sophomore, 4 years in a private school, will cost $218,830. Two students would cost $344,312. This assumes a 6% annual increase. Before you make any college plans, there's two things you must know. How much will it cost? What impact will that expense have on all other financial goals, such as your retirement, other children's education, and way more importantly, your lifestyle? If what you thought to be true about financial aid turned out to not be true, when would you want to know? None of the following assumptions are completely accurate, yet most people believe them to be truth. Income is too high to qualify for financial aid. Income is but one of 7 factors used to determine financial aid. Private school costs more than state schools. Private schools typically have more money to offer and usually graduate students in just 4 years. Debt load will help financial aid need. Debt does not favorably impact financial aid eligibility. The impact of college expenses. Mom and dad, ages 45 and 46, anticipate retiring at age 65. Current combined income, $175,000. Non-retirement savings, $138,000. 2 college-bound children. High school senior, 5 years in a state school. High school sophomore, 4 years in a private school. The impact would be $344,312 projected out-of-pocket expense. Once again, assuming a 6% increase. Opportunity cost at retirement. The impact of this is $789,456. Can you really afford this? Are you retirement ready or not? So what this says is that if you kept that money for yourself, you would have an extra $789,456 in retirement. Would that make a difference in your retirement? It assumes a 5% rate of return on your investments, 5 years for child 1 at $21,000, increasing at 6% annually, and 4 years for child 2 at $42,000, increasing at 6% annually. Parents' retirement in 20 years. A typical approach: pay college costs with current savings. So take the money out of the bank that you've saved up and pay for college. Once funds are exhausted, look for opportunities to borrow both federally and private loans. Second job, added income. So go to work harder to pay for the college. Look for help in completing the financial aid forms and data. So college planning 101 is as easy as applying for financial aid, first things first, Become cash flow efficient. Avoid wealth transfers. Now, what does this mean? Well, what this means is that most people are transferring money unknowingly and unnecessarily out of their life. So if we can find money that you're transferring unknowingly and unnecessarily out of your life, would you save it? Would that make a big difference with regards to not only your retirement, but with regards to paying for things such as college? Credit opportunities, determine borrowing sources. What different places could you actually finance this from? And your last resort would be to deplete your assets. See, it takes a very long time to build up assets. The last thing you want to do is deplete them. Without proper planning, you could potentially miss out on up to $31,000 in guaranteed government-backed student loans, plus additional savings possibly exceeding 1 year cost of attendance, potentially creating $138,529 additional funds for retirement. Would that make a difference? I bet it would. So what's your next step? Well, you would be very wise to calculate your out-of-pocket expenses. You must always be aware of the type and the amount of help you can expect from your target colleges. Only with an accurate projection of true out-of-pocket expectations can you accurately assess your ability to pay for college, the impact paying for college has on other financial goals, and the best financial approach available to you. So let's look at some of these benefits. Well, where should I save to? Well, let's say that the benefits I'd like to get are creditor proof, guaranteed growth, tax-deferred accumulation, tax-free use, high contribution limits, competitive rate of return, disability protection, financial aid invisibility, and transferable upon owner or beneficiary. Now, those things being said, that would be the perfect world. That's what I'd like to have. I'd like to have all of those things. Well, if I was to go over here and look at a 529 plan, it is creditor proof. It is tax-deferred accumulation. It's tax-free use. It's got competitive rates of return depending upon where I invested at. And it's transferable upon owner or beneficiary. A Coverdale plan. Well, it is tax-deferred accumulation, but it doesn't get creditor proof. It doesn't get guaranteed growth. It's tax-free use. It does not have high contribution limits. It has competitive rates of return. It's not disability protected. It's not financially invisible, aid invisible rather. And it is transferable. If we look at paid tuition, creditor proof, tax-deferred accumulation, competitive rates of return, and transferable. If we look at an UTMA or UGMA, we can get high contribution limits and competitive rates of return. And we look at the stock market, we have high contribution limits, competitive rates of return, and transferable. And then Roth IRA, we get tax-deferred accumulation, tax-free use, competitive rate of return, financial aid invisible. Now that's pretty cool. So what does that mean? That means that when I go and I apply for my financial aid, they don't actually see this account. So when I look at all of those and I look down there, at best, I'm getting 50-60% of what I wanted to get. But if I go down here and I use a properly funded, maximum funded life insurance policy, I get all of these things. So the question I always ask people is if you could grow your money tax-free, you could access up to 85% of it at any time tax-free, put it back if you want, get most of the gains of the market, never participate in losses, and when you died, it passed on at 2 to 3 times that amount tax-free, would you want to do that? And the answer is, of course you would. But see, the key to that is knowing first how to do it, and then making sure you get it funded, which takes a certain amount of time to do so. One of the things to remember is that if I build any one of these other accounts and my kid does not go to college, then suddenly some of those things go away, such as the tax-free benefit. And people say, well, my kids are going to college. Well, are you sure about that? And you also have to drain that account when the time comes. And it took all that time to build it up to drain the account when you actually could have leveraged that account if you used the right product in order to do that along the way. So the thing to remember is that there's always more than one way to do something. And in your particular case, what I want to suggest to you is that if it's college planning you're thinking of, wherever you are in life right now, now is the time to do that planning. So be sure to reach out to us. Let's set up a time and let's figure out what is your best approach to it. It might be a 529. It might be it might be any one of those things. But let's find out which one will work best for you. Remember to live like you're going to die tomorrow and plan like you're going to live forever because you just might. Keep smiling, and I look forward to meeting you in the very near future.